Good morning, traders. I'm Greg McKenna. Welcome to Markets Morning. It's the 8th of October 2018. Being a Monday, I'm going to have a look at the weekly setup, but just a quick recap of Friday night and non-farm payrolls. In many ways for traders, unless you were sort of long US dollars and short up the wazoo for US 10s and bonds, it was almost the perfect result. And I say that because the 134,000 jobs that were created, or that non-farm payrolls reported, was well below the 185,000 that the market expected. But the $70,000 of revisions in the previous 2 months got it back up to above 200 grand, and that kind of mitigated the extent that we saw an unemployment rate fall to 3.7%, which is the lowest since 1969. If we had if there had been no revisions to the previous month and printed 185 or 200, well then heck, we would have had these US 10 years at 3.3 or above. We would have had the S&P closing below, not on support. We would have had the US dollar fairly raging. So in that sense, it's a good number in terms of its evenness. Of course, because it was that mild kind of number, is the market slowing down? Probably not, but at least it looks that way from non-farms. It has taken some of the pressure off. And of course, the RRR cut from the Chinese authorities, which releases about 750 billion yuan. So let's just round that really quickly to 100 billion US dollars into the Chinese banking system, is another positive, which could sort of change the outlook for stocks. We'll have to wait and see what happens. If you take my view, which is the Chinese are cutting because they need to, then you're probably going to take a different approach than if you take a really optimistic view of they're going to put all this money in and they're going to fix the Chinese economy. I don't think the market's priced for China weakness properly anyway, so we'll see. Anyway, let's dive straight in. I'm going to start with the US 10 years and then we'll go through the normal stocks. So this is the chart that I use for the 10s before I get and do my weekly 30 markets or so chart scan. What we've got here is we've got the daily 30 years, we've got the weekly 30 years, and we've got the monthly. Now, I want you to concentrate on the monthly because we're doing long term here today. It's a Monday. That's a break. That is a big break, a significant break. This only goes back about 20, 25 years, but still a significant break of an important trend line. If you then look at the rate of change of bonds on the weekly basis, you can see it's broken out here. And the next level, the next target for this move is actually 3.28. We're at 3.23 or thereabouts now. The curve is above 30 points again. So we've got a market that's heading higher. We've got US Economic Surprise Index that's still in positive territory as opposed to where China is and where the EU is. UK's just in positive territory. We have Australia very strongly in positive territory, but it's not helping the Aussie dollar. The key thing here is that labour market does suggest that the Fed is going to continue to tighten, and bonds are factoring that in with the way that they are trading right here and right now. And that's the important thing. Indeed, what we heard from Raphael Bostic and I've forgotten the other one. John Williams, I beg your pardon, from New York. So what we heard from them was that rates need to get back to neutral and that they need to act and do something about it. Just quickly before I go into stocks, into currencies, I want to bring up and my machine's slowing down as per usual when I'm doing this for some reason. Just give me a sec. So as you can see here, this is the CFTC position sizing data. Now, there's a lot of chat recently about whether or not it's instructive or not. Have a look at the written version of Markets Morning today, and you can see the relationship between specs and the euro and specs and the yen. Much stronger in the euro than the yen, but that's because many other factors drive the yen. Weight of money does drive markets. You can't argue against that. You can argue about what the drivers are, but when all those drivers push people to actually place their bets, that's what drives markets. And that's what we've seen in the euro in particular and in dollar yen. Currently, we've got 114,000 shorts as at last Tuesday for the yen. that means very, very long dollar yen. And the short is about as short as we saw in July this year. So that's not that far away. The key thing here, if stocks go off, that's a lot of power for position reversal that could see dollar yen fall precipitously. So just keep an eye on that. It's in that chart's in markets morning anyway. Let's have a look at the euro. And you can see here, this is the weekly version of the euro. Just a nice simple chart. Downtrend continues. It couldn't get back up through that. I've had that line in there for ages. It's above the lows from last week, but it does look like it does have further downside. But from my point of view, it's still a 113, 118.50 range at the moment. I'm ranging rather than bearish per se. Now, if 113 breaks, well, then I'm calling 108 straight away. But it's got to break. Those two candles, though, they are net bearish for euro. In terms of dollar yen, a very interesting position that it's in right here and right now. I'll blow that up so you can get a look at last week's candle. That is a big reversal, folks. That is a warning that potentially that was a false break. Now, that blue region that I have in my daily chart, which is not on this one, pardon me, that was right at the top, that 114.70 something. And remember last week I was saying that I thought we'd pull back and retest that trend line. Dollar yen is sitting right on that daily trend line now. So at 114 sort of 55.60, if it gets down through there, it could run and head a little bit lower. Sterling is doing well. If I draw a little trend line here for sterling, I know this is a messy chart. If I draw a little, pull that one back, sorry. Let's just get rid of that. Delete. There we go. You can see better now anyway. Right, so we've got this nice little two-touch trend line, so it's keeping there. Of course, we've got to get up and through 133 sort of 10.20. That's the 38.2% retracement of this move anyway. But for the moment, with all this nice noises coming out of the EU and with the MACD pointing higher, it does suggest we get back into the 132.20s perhaps, maybe even 133. But that is a hard nut to crack, 133 for sterling. In terms of the battler, re-intensification of the downtrend. We've got this it's a long-term downtrend. The momentum continues, so the broadening of the MACD, which just simply means that the fast-moving average is moving down at an increasing rate relative to the slow-moving average. That just tells you the pace of the move. And so what do we got? We've got a target of about 69.20 if you look at it there. 68.50 is the actual target. So it might take some time. That's what, a couple of weeks, 5 weeks, 6 weeks. Probably get there before that, but this is still a sell-on rallies for the Aussie. The Aussie's interest rate differential to the US doesn't recommend it. The Aussie data certainly does, but that pales into insignificance about what else is happening. If stocks break wide open, which they could, we'll see in a sec. If stocks break wide open, then the Aussie and the Kiwi are going to get belted. Dollar CAD, same sort of thing, bounced off the weekly trend line. Right, so it's in a downtrend, but it's bounced off. So you've got to respect that. So that 127.50 to 128 is support zone for dollar CAD. It's at 129.50 now, so still looking okay, and that would be expected to go higher if the US dollar continues to march on. Kiwi, weekly Kiwi, like the Aussie, re-intensification of the downtrend. 64.40, this weekly scan I do, 64.40 has been my target for a while. It's hit 64.40. I'm now looking at sort of 61 to 62 cents as a target. So we'll have to wait and see how that goes. Is there a chance of a pullback? Of course there's a chance for pullback. Because normally here, at these sort of levels, I would look for a reversal. But we haven't seen the pessimistic crescendo, if I could put it that way, of Kiwi or Aussie at the moment. So they retain their downside pressure. Moving on to one thing. When I did my my scan, the thing that popped up in the correlations, what am I, 10 minutes in, it's that the correlations are not too high in a cross-asset sense, but there are some signs of risk aversion starting to rise. Now, of course, that's, you know, copper and Aussie yen and stocks and those kind of things. So keep an eye on those this week. Gold. Gold looks like, this is the really interesting one. I look at cross assets because I'm looking for an emerging difference or an emerging trend that signals something else is going on. What I really like about gold here and trying to walk its way out of this downtrend, you know, MACD suggests that it's getting close. It's still in an 1180, 1220 range, but if it can get up towards, I think it can get up towards that sort of 1215 to 1220 region. If it can break 1220, then 1240, that's another 20 bucks. But the key thing here, gold's finally caught a bid when things are going to heck. Just keep an eye on that. Now, of course, it helps that euros stopped falling. Of course, it helps that sterling stopped falling. So it's not just a universality about the US dollar strength, you know, the Aussie's under pressure, that kind of thing. But the fact that the Aussie's under pressure and euros rising, the fact that Aussie yen's falling and dollar yen's falling, the fact that gold's starting to catch a bid tells me that there is some sense of market funkiness happening. If that's the case, there could be 20 bucks, maybe even 30 or more in gold going forward. Copper is stuck in a very tight range. I'll show you on the dailies because you can't really see it on the weeklies. But see, you got 270, 274.5 up to 286.5. Back to the weeklies. The weeklies suggest that copper, it hasn't been able to get back up to 293, which is, this is the bottom of this range it needed to get to. So it does reflect, even though the MACD has started to, you know, the moving averages have come together. So you've got this MACD coming together. It does look to me like it could re-accelerate to the downside of 274.5. Give it half a cent. Call it 274 if that was to break. If we look then at Brent and then WTI, weekly Brent, that's an ominous candle. So just keep an eye on that. My suggestion would be a test back towards 80, towards the break, is likely. So what's the oil news? A couple of things. EPIC is switching a gas pipeline to oil, 400,000 barrels a day. Rumours that the US is looking at waivers for Iranian oil. Stories that India is buying Iranian oil regardless. I watched a Joanna Lumley show on television with Mrs. Mack last night on Iran. My goodness, I'd love to go to that country. It looks gorgeous, leaving aside all the other political stuff. But the people, the country. As someone who did ancient history when I was a kid, just amazing. Anyway, Brent looks to me like it might revert a little bit lower. Interestingly, though, Bloomberg has a story that Mohammed bin Salman, so that's the Saudi Crown Prince. Where's my WTI? There it is. The Saudi Crown Prince has basically given or thumbed his nose at Donald Trump, saying that we've done our bit in an interview with Bloomberg. Another long tail. I've suggested 72.20 to 70. Well, when I say I've suggested it to myself when I wrote out I've written break and reversal suggests 72, figure 50. So it's rolled over and breaking short-term support, suggesting a move to 38% level, which is 72.14. So down in that zone is where it looks to me like oil can go, but still lots of water under the bridge, particularly as we head towards the imposition of the Iranian sanctions. This is getting really interesting. I showed you the dailies, and we'll talk more about the dailies tomorrow. But basically what we've got, and this is futures-based, don't forget, we've got the S&P having broken the more vertical and shorter-term uptrend, but then found support at the bottom of the next level, which is essentially the weekly. So if it gets down through 2880, then it would look like it goes to 2860. If it gets down through 2860, it can easily run down to sort of 2780 or thereabouts. Of course, we've got this old ledge here, which I think is 2795, but the MACD rolling over, stochastics where they are, I wouldn't be surprised with further downside. Now, the tension, and there's a lot of stuff I'm seeing. There are some chartists out there who I'm watching who are trying to line up every single thing in a kind of a forward-looking manner. as opposed to raising the risk. So with my trading and with when I'm talking to you about charting, I'm talking about if then. It's very formulaic. If that breaks then, rather than that will break. Because to be honest, I respect, lines and levels unless or until they break. Anyway, so if stocks start to fall, bonds will start to rally. What happens then? We get this kind of support. Will it happen this time? Will bonds actually start to rally? Or is it bonds rising? Don't forget, a rally in bonds is when they come down in rate, and a sell-off is when they go up, because what the rates do is inverted to price. Do you know what I mean? So we'll have to keep an eye on the relationship between bonds and the Aussie dollar. Now, when it comes to the local market, we're kind of trapped. The weekly doesn't show anything. If you go to the daily, you can see we're trapped. 62.25 on the top side and about 60.90 on the bottom side. The key thing here is that copper falling, risk off, Aussie yen down. Every time the Aussie market is trying to rally, it's getting chased back. So the atmospherics around global markets need to change. Now, that could be that, it's Columbus Day in the US. That could be that this China thing gets things moving, but we'll have to wait and see. So that market looks to me, if I just go back for 1 sec, sorry, 59, where's that? That's 6,000. So about there. I'm looking for a move back towards about 6,000 on the weekly charts. That's about it. Where's my DAX? My DAX is still respecting that downtrend line. Don't worry too much about that break, although it is significant, I guess. From a DAX point of view, on my scan, what I wrote to myself was that it's broken a pennant after a stall on 38.2% of the up move held. It's tried and failed to retake the pennant bottom. 11,734 is my target and the level I'm watching. If it breaks 11,734, it drops another 600 points. And medium term, 11,000 is the key support, and if that breaks, it goes to 9.9. So big picture view for the DAX. You can see how that does look like it's rolling over, but there's not a lot of momentum on a weekly basis. Righto, that's it. I'm going to quickly do Bitcoin. Still going nowhere, still respecting that overall downtrend. Got support at 56.50 to 57.50. It's got resistance just here about at 67, then 74, and then we'll see how it looks. But overall, not too much. Righto. So it's been a long one today, but there's so much to talk about. Those US bonds are really important. Keep an eye on that. It's Columbus Day. Not a lot of data out. German PPI tonight. So they're the key. China's the one to watch if you're trading today. What's the reaction to the Triple R? What's the reaction to the Cajun non-manufacturing PMI and the composite PMI that'll be out today? That will tell us what happens over the next sort of 36 hours until US markets come back fully. That's it. On behalf of myself, I want to wish you all the best. Happy trading. I'll be back tomorrow. Bye for now.